Risk management is arguably the most critical skill a trader can develop. It's not flashy, it's not glamorous, and it's not about predicting the next big move. Yet, without it, even the most brilliant strategy can crumble in a heartbeat. I always tell new traders that trading without risk management is like walking a tightrope without a safety net. One small misstep, and you're falling, potentially out of the game for good. Let's unpack what I mean by that. Trading is unpredictable. Markets move for reasons we can't always control: geopolitical events, economic surprises, even a single tweet can send prices swinging. But that's exactly why risk management is your anchor. One of the most effective tools in your risk management toolbox is the stop-loss order. Simple in concept, but powerful in practice. A stop-loss is a preset order that automatically closes your trade if the market moves against you beyond a certain point. It ensures that a small loss stays small, and prevents it from turning into a catastrophic drawdown. I remember early in my career, I underestimated risk management. I had done my analysis, I was confident in my trade, and I thought I could ride it out if things turned against me. Spoiler alert, things turned against me, hard. Without a proper stop-loss in place, I watched gains evaporate, and my account took a hit that set me back for months. That experience taught me one of the fundamental truths of trading: it's not about avoiding losses, it's about controlling them. Let's talk about the benefits of risk management more concretely. First and foremost, it preserves your capital. Trading is a marathon, not a sprint. One bad trade can wipe out weeks or months of gains if you're not careful. By managing risk effectively, you make sure you're still in the game when real opportunities arise. Second, it reduces the emotional impact of trading. When the market moves against you, it's easy to panic, make impulsive decisions, or double down out of fear or hope. A well-placed stop-loss removes that emotional element, allowing your plan, not your nerves, to guide your decisions. Third, risk management enhances consistency. Over time, traders who manage risk systematically see steadier, more predictable performance. And consistency, my friends, is what leads to long-term success. Let's now dive into the mechanics. There are several types of stop-loss orders. Fixed stop-losses are the simplest. You set a specific price point and the trade exits automatically if the market hits it. Trailing stop-losses are dynamic. They move in your favor as the market moves, locking in profits while still leaving room for further gains. And some brokers even offer guaranteed stop-losses, which execute exactly at your specified price, even during market gaps. This might come with a small additional cost, but it's worth considering if you're trading highly volatile instruments. I want to bring this to life with a detailed example. Let's talk about Mark, a currency trader I know. He trades major pairs like euro to US dollar and pound sterling to US dollar. Despite being experienced, he faced challenges with risk during high volatility periods. For a recent euro to US dollar trade, Mark identified a support level at 1.145 and entered a long position at 1.15. Instead of leaving it to chance, he set a fixed stop-loss at 1.144, limiting his potential loss to just 60 pips. This disciplined approach meant he could sleep at night without stressing over market swings. In another trade, he spotted a downtrend in pound sterling to US dollar and went short at 1.32, with a stop-loss at 1.325. But here's the clever part: he added a trailing stop of 50 pips. As the price fell to 1.3, the trailing stop moved with it, locking in profits while letting the trade run. Eventually, the market reversed to 1.305, triggering the stop-loss and securing a significant profit. By monitoring his trades and adjusting stops appropriately, Mark was able to protect his capital, lock in gains, and maintain his emotional composure. Here's a practical tip from my experience: never set your stop-loss at random. It should be based on support and resistance levels, volatility, and your overall risk tolerance. I've seen beginners place stops just a few pips away from their entry, often too tight, leading to premature exits. Others leave them too wide, risking more than they can afford to lose. The balance is crucial. It's not just about avoiding losses, it's about ensuring the trade can breathe while still protecting your capital. Paul Tudor Jones once said, "The secret to being successful from a trading perspective is to have an indefatigable and an undying and unquenchable thirst for information and to manage your risk." That quote sums it up perfectly. You can have all the knowledge in the world, but if you're not protecting your account and managing your risk, it won't matter. I also want to highlight a personal story. Early in my trading, I chased a volatile tech stock without a stop loss. Within an hour, the price dropped nearly 15%. I panicked, tried to exit manually, and ended up losing twice as much as I could have with a proper stop in place. That single mistake taught me more about risk management than weeks of theory ever could. From that point on, every trade, regardless of size or confidence, had a defined risk level and a stop loss. It became non-negotiable. So, what's the takeaway for you as a beginner trader? Before you place a trade, always ask yourself, what's the worst-case scenario, and how will I limit it? Decide the amount of capital you're willing to risk. Set your stop loss. Consider a trailing stop if you want to protect gains. Regularly monitor and adjust if needed, but never compromise on your discipline. That's how you stay in the game and grow your account sustainably. Now I'd love to hear from you. What's the biggest challenge you face with implementing stop losses in your trades? Is it setting them correctly, sticking to them, or adjusting them as the market moves? Share your experience in the comments below. I read them all and love learning from your real-world experiences. Remember, trading isn't just about making profits. It's about protecting your profits, minimizing losses, and staying disciplined. Incorporating effective risk management strategies, like stop-loss orders, will not only safeguard your capital but also give you the confidence to navigate volatile markets. Consistency, patience, and discipline, that's what separates traders who succeed in the long term from those who don't. That's all for today. Stay disciplined, protect your capital, and I'll see you soon on the Ultimate Trading Podcast for Beginners.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!